confusion. Can't you hear the sound that's in the air? It's rock and roll. 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 It's rock and roll.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is the Hump Day edition of the Real Investment Show. So lots of stuff to get into this morning with markets and kind of everything else. Real quick to correct a mistake I made yesterday. I know it doesn't happen often, but I said CPI report was today. It's actually tomorrow. So Thursday is CPI, Friday is PCE. So we'll get those inflation numbers out. But anyway, outside of that bit of a correction, let's talk about markets. Yesterday, of course, is just kind of this continuation of the sell-off. We're moving into the kind of the heart of summer, so to speak, for the markets, which is August and September. Volume is low. The vast majority of Europe kind of closes down. If you live in Europe, you get the entire month of August off for vacation. Must be nice. But so volume dries up, so you have a little bit more volatility in the markets. And again, the market had a very strong rally since the beginning of the year, so what we're going through now, really not a surprise. We talked about the fact we're wrapping up earnings season, and that's coming to a close pretty quickly. There's a couple of companies that report late, NVIDIA being one of those. But for the most part, we've got the vast majority of the S&P now behind us. A few reports out today and tomorrow, but pretty much by the end of this week, that's going to wrap up earnings season. So far, it hasn't been bad. We're beating very lowered estimates, so not surprising. We've got a very high beat rate of earnings. But it has been interesting that the reward for beating earnings has not been fantastic. Companies that are beating earnings are being rewarded to some small degree for the most part. Now, there's some outliers of that. There's been some companies that reported earnings that have done very well. But for the most part, across the average, companies beating estimates really have not been, handsomely rewarded. Their stocks have traded up a little bit, but that's because stocks had such a big run up to this point that and we talked about this before, is that kind of all the good news had gotten priced in. And so when these companies announced that they beat earnings, it was like, well, you better beat earnings because we were expecting you to. And so the reward really wasn't there to be had. Now, again, as we get further into this year, we'll see what happens. But Something we'll talk about this morning as well. If you take a look at the NFIB report yesterday, so this was kind of interesting. The National Federation of Independent Business. Now, the vast majority of those that are surveyed are very small businesses. They are 10 or less employees. In fact, about 60% of the survey goes to companies with 5 or less employees. And you go, well, what do they know about the economy? Well, they are the economy. 50% of basically of the economy are very, very small businesses. Think about all the businesses right around your house that are creating income and activity for the economy. They have 1 to 5 employees. A lot of these businesses are. Maybe they have up to 10. There's not that many companies like Apple and Google, these companies that have 10,000 employees or more. Those actually make up a fairly small percentage of the number of businesses in the country. Out of 30 million businesses that are registered in the U.S., only about 6 million of them have employees. And so again, when you take a look at these, something like that small business survey, that really is kind of the heartbeat of America. Now, what we're seeing there is an uptick in their sentiment. They're starting to see better opportunities. Now, they're still concerned about sales right now, of course, but their overall sentiment is beginning to pick up. They're also starting to spend more money on CapEx. So this is an actual very interesting turn. And of course, if you take a look at some of the economic data, we've had this and this is kind of an article that we had written out yesterday talking about market cycle lows and beginning to look for some signs of improvement. And we're beginning to see that, right? We're coming off these very low levels of economic activity, starting to see a little bit of an uptick here. Does that mean that all the concerns are behind us? Absolutely not. But it is important that we are starting to see a little bit of a pickup here. Sentiment is improving of consumers. So the risk of this kind of deep negative recession everybody has been worried about may be fading somewhat. We'll see, right? We'll see. It's a bit early, but we are starting to see some positive kind of turn in some of this data. Again, it's very early, so it can certainly turn back lower, but those are things we'll talk about. Okay, so we got some stuff to get into this morning, talking about stimulus and support and those type of things. Here's what you need to know before the bell this morning. The market did sell off here a bit yesterday. And again, we kind of talked about 2 things yesterday in particular, when we were doing our morning market wrap, is that we had rallied to the 20-day moving average. And we said yesterday, if we took out those previous lows of this kind of sell-off, that would suggest that probably we're going to continue lower. And we actually did that yesterday morning. We took out that previous low. Now, we did rally back into the end of the day, had some buying. So that was kind of positive, but we're still working this kind of clear trend towards that 50-day moving average. So again, the market's still under some selling pressure here. MACD sell signal in place. We're not deeply oversold yet on the relative strength index either. So again, there's still some more risk here that we could go a bit lower. Flipping over to the NASDAQ, which has kind of been the leader this year by a large degree. It actually came down and tested the 50-day moving average yesterday, bounced off of that. So that's on the tech side, that's actually a fairly good kind of look here. Again, not deeply oversold yet. It is getting oversold here short term. MACD sell signal still clearly in place here. But again, that kind of pullback and support hold at the 50-day moving average for the NASDAQ is certainly encouraging. And again, that kind of really hinges right now on the on Apple kind of getting its act together. Apple recently reported earnings and had a fairly big sell-off. Apple cut right through the 50-day moving average on that gap lower when they reported earnings. Of course, earnings were not, fantastic stellar as everybody expected. This is one of those one-off companies that actually got punished for some bad earnings. Cut right through the 50-day moving average, did find a bit of support at the 100-day moving average yesterday. So really, this kind of position of the NASDAQ is going to be kind of hinged on whether or not Apple can get its act back together here or not. So Apple's such a big component of the NASDAQ index, also the S&P, but kind of more of a representation. We need to see Apple begin to improve here to help give the overall NASDAQ support. Apple is very oversold here, so if you've been looking for an opportunity to potentially add to your position in Apple, this may actually be a fairly decent place if it can continue to hold here. So again, if you break the 100-day moving average, the 200-day moving average for Apple is going to become much more important. Flipping back out of these kind of large mega cap stocks, which have really been the driver this year for the most part, And again, we've talked about this before, but when you start thinking about the overall market, this has really been a market driven by about 7 stocks, and that's the Apple, the Microsoft, and the Googles of the world. The small cap, mid cap index, which is the Russell 2000. It's turned over here with the rest of the markets. But again, we have to kind of zoom out. When you take a look at this this chart, we've got to back this up a bit, because you had a 20% decline in the market for the IWM last year, along with the rest of the indexes. The problem is IWM has never gotten out. They've never gotten back into a bull market trend yet, much as, as opposed to the S&P 500, which has clearly been bullish since October. The small cap, mid cap index has literally gone nowhere. Has just been trading sideways. So again, this has still been a very bifurcated market of just 7 stocks for the most part, driving the overall indexes higher. And again, this is why it's important for Apple to find its footing here if the NASDAQ is going to kind of continue to hold up. But again, once you get below that big surface of those big mega cap companies and look at small and mid cap, they have really not participated in this. In fact, yesterday's sell-off took the IWM back, or the Russell 2000 back into a bear market. So again, very different stories of very different groups of stocks. Anyway, that's what you need to know before the bell this morning. We'll take a look at this again tomorrow and see where the markets are trading. Coming up after the break, though, we will pick up with this idea of recession. We talked a little bit about this yesterday. Michael Leibowitz did an article on this as well. And we'll talk about this idea of recession. Is it coming or is it not? We'll talk about it after the break right here on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. So just talking a little bit about, kind of the markets and where they are. Again, we're kind of in this very, interesting period right now. And this is, still, as we've kind of talked about ad nauseum as of late, it's still in this very interesting situation where you have bits of the markets doing very well and then other parts of the market not doing very well. And this certainly, causes some consternation, right? Because when you take a look at the S&P 500 as an example, You go, well, that's, the market's doing great, or the NASDAQ, right? NASDAQ's, we're a bull market, we're doing fantastic. Well, the problem is, though, is that you would have to basically still own a vast majority of your portfolio in just a handful of stocks. And most people, from a risk management point of view, just simply don't do that. But this has been that kind of bifurcation in the markets that we've had this year. So if you own, energy stocks or staples or utilities or REITs or anything outside of just the big 10, big 10, 15 stocks in the index, your performance has not been all that great this year. And that's just a function of the narrowness of this market. Now, it has broadened out here some recently, but particularly earlier this year, it was predominantly 10 stocks driving the markets. And again, this has just been a function of money crowding into a very small area of the markets on expectations of improvement, right? Things have gotten so very negative in October of last year. We talked about sentiment being extremely negative. And so this kind of rally we've seen has certainly not been surprising. And now it's gone a lot further than many expected, but it's still nonetheless, it's been good, right? So the question, of course, this has also confounded a lot of people going, well, what about the recession? We've got to have a recession. We're hiking interest rates and we're going to have a recession. I'm still getting a lot of emails from people going, when this recession comes, it's going to be terrible. I need to be in the bunker, type thing. But there's no evidence of that right now. Now, again, maybe it does eventually, but right now there's no evidence of it. Employment's still doing okay, right? Small business sentiment's turning up. So, there's no evidence of this big crisis event that's coming. So being extremely negative hasn't been a good place to be. Running a normal, diversified, risk-managed portfolio hasn't been great, right? So if you've been in the camp of taking on an exceptional amount of risk, you've done good this year. But again, this isn't a normal market. And again, we'll get some normalcy kind of returning to the market eventually. The market will broaden out. We'll get a rotation between markets and sectors as the economy begins to kind of mature and get back on its feet. So we'll see some of these things. But as we talked about yesterday, and this was, kind of the article that we published yesterday talking about market cycles, right? We'd just been through a very negative market cycle. And so seeing this rally and this turn up in the market certainly wasn't surprising. And we're beginning to see now, the market tends to run ahead of the economy by 6 to 9 months. So now we're starting to see some of that, kind of economic data beginning very slightly, right? Beginning to improve a bit. Just small little improvements. As we talked about yesterday, when you go from -10 to -9 to -8, it's still negative, right? But it's getting better. I was really sick yesterday. I'm not as sick today. I'm getting better, right? And that's the thing you have to think about with some of this data, is that it's not always about it being, we tend to think about things like the ISM index as a good example, right? It's in contraction, means we're going to have a recession. It's in expansion, so we're not in a recession. We tend to think about it very binary, right? We go, it's either in expansion or it's in contraction. There's no middle ground here. But see, that's not the correct way to look at that data. And we do this all the time. The media is terrible about this. ISM is 55. Economy's doing great. ISM manufacturing index or services index, but either one doesn't matter. ISM index came in today and it's in expansionary territory. Economy's doing fantastic. Next month, it's 54. Economy's doing great. Everything's great. We're in expansion mode. Nothing to worry about. 53, 52, 51, 50. Everything's fine. We're still, we're at 50. We're still in expansion mode. Everything's fine. 49. Oh my gosh, we're in a recession. We're in contraction. See, that's the wrong way to look at the data. The data was telling you there was a problem economically coming months before, because it went from 55 to 54 to 53 to 52 to 51. It was declining. It was heading towards that recessionary territory. It was telling you that, hey, I feel great. Today I don't feel as great. Next day is I don't feel as great as I did the day before. And every day I'm getting a little bit sicker, right? But the economy is not binary, right? It's not, I feel great, I feel terrible, I feel great. That's not the way the economy works. It's the trend of the data that's more important. The trend of the data has been very negative now for over a year. The economy's been very sick for over a year. It would not be surprising to see the economy start to feel a little bit better. Doesn't mean it's still not sick. It's just not as sick. And the market tends to pick up on that a bit. Now, I saw a very funny video because it's back to school time. The reason Danny Ratliff usually joins us here on Wednesday, he's not here today because today's the first day of school for his kids. And I know it varies a couple of days. My daughter is meeting me today for lunch at 11:30 because she starts school Monday. So this is her last hurrah. So everybody's getting ready to go back to school. So I saw a very funny video, but it's very much the kind of this analogy for how we view economic data. The mother says, she makes this video to her kid, and she says, look, when school starts, you've been living off a diet of Cheetos and Coke all summer. I don't want to hear about your stomach doesn't feel well. You can't go to school today. We're not doing that. And she went through all the things, that kids do during the summer that all of a sudden is a problem when it comes back to school. And she says, we're not doing that. You're going to take your lunch to school because I'm packing it for you, and you're going to eat it because you've been eating the same crap all summer. You're going to eat it at school. And so this is the same way we look at the economic data. When things are great, we go, it's all great. When it's not great, it's all terrible. That we never look at the rate of change or the changes in this data that tell us if things are getting better or getting worse. And that's how we have to kind of look at things. We have to start looking at the trend of the data rather than just the message that it's supposed to be giving us. Is it getting better? Is it getting worse? Employment, good example. Employment's still fine, right? Creating 189,000 jobs. So obviously nothing wrong with the economy, right? We're still creating a lot of jobs. But the rate of job growth is slowing, right? The trend of the data in job growth is slowing. That's what we need to pay attention to. It suggests that the economy is indeed slowing down. Now, that does not mean it's recessionary, but it is slowing down. So this big surge in activity that we had in 2020, 2021, 2022, because of all that monetary stimulus, that M2 as a percentage of GDP, which was massive, is fading. It is coming out of the economy. People do have less money to spend. That's going to slow down the rate of job growth. That's going to slow down the rate of hiring. So yes, we're going to see that data return back to normal at some point because it's going to have to be reflective of the activity that is actually going on in the economy. So we're going to get to that point. That will also impact earnings growth, etc. And that's what small and mid-cap companies are telling you. As I was saying earlier, small and mid-cap stocks, they're still in a bear market. Small and mid-caps are very, very, we've said this so many times, small and mid-cap stocks are very sensitive to economic activity because they're small. They don't have the ability to do stock buybacks. They don't have the ability to do, a lot of leverage, these type of things. They just don't have that kind of ability. They don't have that access. So they're very dependent upon the sales that they make and the activity that's occurring with the economy. And what small and mid caps tell you is that underneath the surface of what's happening with these large cap companies like the Apples, the Microsofts, the Googles of the world, there's actually still a good bit of economic weakness. And we know that, right? We know that. But do we start to see some improvement? That's going to be the question. And again, this is, kind of the point of the article yesterday. It's kind of the point of Michael's article today. Is there's still just a tremendous amount of stimulus within the economy. Just a massive amount of it. Just because I send $5 to Brent and Brent spends it doesn't mean that the $5 is now gone. He spent the $5. Well, where'd the $5 go? It went to somebody else who he bought a product from who now has his $5. They then spent that $5 on something else. So those people now have $5, right? Those people spend it on something else. And so the next group has $5. That $5 takes a long time to circulate through the economy to where it begins to just, fade into the midst of, so to speak, of normal economic activity. It takes a while. And that's what we're seeing with a lot of this stimulus. It's still there. It's coming out. Savings rates are declining. A lot of the stimulus is still fading. But there's still a lot of that activity still going on within the economy, and that's why things have been more resilient than we would have expected. Okay, quick break. We'll come back. More of the Real Investment Show coming back right after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for the Real Investment Show, or just click on the show links at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You're listening to The Real Investment Show.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So last night I wasn't sleeping well, so I got up and went into the living room, just kind of laid down on the couch for a little bit. And she always leaves a light on in the front of the house.
The Real Investment Show podcast. Same show, your schedule.
This morning my wife is up. She's like, honey, did you know that the lamp was off in the living room? Why is it off? Did somebody break in last night? I said, yes, honey, a climate activist broke in last night, turned our lamp off.
At realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
one of the key concerns that has been floated around over the last year or so has been the word stagflation. In fact, if you take a look at the Google searches of stagflations in 2020, the word stagflation in 2021, there was a massive spike in the number of people searching for stagflation. And, this is a period of high inflation, low growth. And of course, this was, kind of the big overriding concern, and that's all but disappeared lately. I mean, we had, if you take a look at, again, if you go back and kind of look for the word, Google searches on stagflation, nobody's really searching for that anymore. Concerns about a recession have basically evaporated. Take a look at the number of analysts expecting recessions, that's dropped markedly. So the adoption of the soft landing scenario is now becoming kind of the mainstream thesis for the markets. So we have economic growth returning to normal. Now, right now, the Atlanta Fed has GDP growth for the third quarter pegged at 4%. So we've cranked out about 2% growth over the first two quarters. They're now expecting a 4% growth rate in the third quarter. That will slow down as we get further into the third quarter. I mean, this is only the beginning of August, right? So we have August, September still. So we're likely going to see some, kind of some weaker economic data come in, and that'll bring that down. But probably still it's going to peg around 3% for the third quarter. So again, it's not bad growth, right? 2%, 3% growth. That's not bad economic growth. And this is despite higher interest rates and everything else going on in the economy. So the economy is being pretty resilient here. And inflation is falling. We're now down to 3% inflation. So obviously, if inflation is falling and economic growth is doing okay, then stagflation really isn't as much of a concern. And that's why you're seeing that concern about stagflation now beginning to disappear. And you're also kind of seeing the concerns. And again, if you're growing at 2 or 3%, which we are right now, then the concerns of recession are going to fade. And that's also happening. Now, this doesn't mean that 2 quarters from now, 3 quarters from now, 4 quarters from now, we can't be talking about recession again, right? And it actually wouldn't be surprising. As we said last year, everybody was expecting a recession. If all experts agree, something else tends to happen. Well, last year, all experts agreed we're going to have a recession, and guess what? Something else tended to happen. Now, all experts agree that we won't have a recession, so we'll see. But the issue of stagflation is interesting from the standpoint that we still have a tremendous amount of deficit financing going on. It's interesting, we're getting ready for elections, so you hear a lot of talking points come out. Biden administration has created more jobs than any other president in history. Well, not really. Because you have to factor in the fact we shut down the economy, and then we said, okay, now you can reopen back up. So all we did was hire a bunch of people back, of people that we laid off. That's not really creating new jobs, right? So when you really talk about employment, you're talking about how many new jobs were created during that administration. Remember, no president creates jobs, right? Jobs are created by businesses. The president that happens to be in office gets credit for the job creation because, well, he was president, right? But he didn't really do anything to create jobs. But we have to talk about jobs as a standpoint of creating new jobs, right? So really the question becomes how many new jobs have been created from the pandemic peak, right? So going into the pandemic, before we shut down, if we had 1,000 jobs, total employment, right, so 1,000 people, and today we're at 1,010 people, right? We've created 10 jobs. We didn't create 510 jobs because we laid off half the population, right? And then hired half that population back. So we have to really measure it from where we were pre-pandemic to where we are now. That's how many new jobs have been created, and that hasn't been fantastic, right? And that would be expected, right? We hired people back, but there really hasn't been a need to overhire to a tremendous degree. And businesses have been very, very cautious about this. And over the last year or so, we've talked to a lot of companies. Amazon's a good example, laid off 27,000 employees, trimming back, kind of rebalancing the workforce for where we are economically. Based on supply and demand, I need this many employees. So I overhired, coming out of this because we had $5 trillion worth of stimulus. People were buying things like crazy. I overhired people. And now that stimulus has faded, I don't need those people, right? So we're seeing a rebalancing of that labor force within the economy back to what the economy, that supply and demand within the economy actually generates. So when we talk about stagflation, it's a high inflation, low growth environment, but inflation's falling. Right? You're at 3% inflation right now. Employment's doing okay. Economic growth is doing okay. So we're just kind of really returning to normal trends. So all these fears of stagflation and massive recessions and all these things have all started to kind of fade now because, well, they haven't happened. It doesn't mean they won't happen at some point in the future. But it could be a year from now, could be 5 years from now, could be 6 months from now, right? We just don't know when this is going to happen. But eventually they will, right? Eventually we'll have a recession again. Don't know when. Something will cause it. And, then markets will respond accordingly. But that's the issue. So, it's not surprising that we're seeing a lot of this stuff fade. However, there is a risk, and we've talked about this before, deficit spending is going to have to increase. And, it is increasing, right? So we had this massive surge in the deficit because of the stimulus payments. The current administration is taking credit for that reduction in the deficit because we didn't renew the stimulus, right? But all we did was just not spend the same amount of money, so the deficit reduced. But now the deficit is back onto its normal trend, and we're now at the big. If you X out that $5 trillion surge in the deficit, we actually have the biggest deficit on record. X that round of stimulus, because we're continuing to spend more and more money to support the economy. And now that interest payments are making up almost $1 trillion of just servicing debt, servicing our debt, that's eating up about 1/5 of our tax revenue just to service the debt. And then, of course, the rest of that pretty much goes to Social Security, Medicare, Medicaid, etc. So the deficit is going to continue to increase, and as a function of that, there is a risk of much slower economic activity in the future because deficits are going to track along and are a function of slower economic growth. Why? Because we're issuing debt for non-productive purposes and we have to service that debt. So that detracts revenue from productive uses into debt service. So you get slower economic growth. This also leads to slower rates of inflation. Also leads to lower rates on interest rates because you simply can't afford to maintain high interest rates in a highly leveraged economy. And this is the one mistake that, I'm hearing a lot lately, and we're going to touch on it in this weekend's newsletter, is that debts are, the interest on the debt's going to have to go up because we're issuing all this debt. So interest rates have to go up. And this is one of the big stories. Stagflation is not a risk anymore. Recession is not a risk anymore. Not right now. Okay. Interest rates going to 5 or 6% would certainly cause a lot of problems. So if interest rates on the 10-year Treasury go to 5 or 6%, as predicted by some of the smartest people in the country, Jeremy Grantham, Ray Dalio, others talking about interest rates going to 5 or 6%. In theory, they are correct, assuming that the bond market is controlled solely by buyers and sellers. In other words, you have a group of individuals and they say, hey, look, you're issuing too much debt The debt's been downgraded in terms of its credit rating, so I'm going to demand a higher interest rate payment on my debt. And that would be a true story in an environment where it was only rational buyers and sellers controlling the debt. But that's not the environment we live in. In a highly leveraged economy where you have to increase deficit spending just to support economic growth, and again, we have no fiscal responsibility in Washington, you can't have a normally functioning bond market. And as a function of that, interest rates will not be allowed to rise. And we'll talk about that after the break, because the CBO just came out with a forecast for the debt in the U.S. In order to issue that much debt, you have to have a guaranteed buyer. We'll talk about who that'll be right after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show. So just talking a little bit about stagflation, and there was a lot of concerns about stagflation early on. Low growth environment, high inflation, inflation falling. So stagflation really kind of no longer a concern. Never really was a concern because the inflation was never organic. And we said this kind of many times in the past, is that the stagflation argument had some validity if you had a normally operating economic environment, but the inflation was a function of shutting down the economy, crimping demand, shutting off supply, and then giving people a bunch of money, which just created this massive demand boost. And that's why you had inflation, right? It was all artificial. And so not surprisingly, inflation's falling. We've been saying this since last year. Inflation was going to fall sharply just because the money's evaporating and your year-over-year comparisons, et cetera. So that's why stagflation was never a big issue. And now it's gone away. Now the big concern is interest rates. And so we're issuing all this debt, and now interest rates have to go up, right? And this is the thesis. And the CBO just recently came out with their forecast showing just an exponential increase in debt through 2053. And this has also gotten people very concerned about the fact that, well, if you have to issue that much debt, interest rates have to go up. We've got to have 5, 6, 7% interest rates. The problem is, and again, as I said in the last segment, if you had a normally operating environment, that would be true. We don't have a normally operating environment. If the government is going to issue increasing levels of debt, which they will, they cannot do that into a rising interest rate environment. The economy can't sustain higher interest rates. Think about for a moment all the things tied to debt in the economy today, which, by the way, we have the highest, we're basically running a 5-to-1 leveraged economy just on the government side. It's almost 10-to-1 when you include consumer debt, et cetera. We have a tremendous amount of leverage creating each dollar's worth of economic growth in the economy. And the vast majority of that debt has been issued at very low interest rates. So think about all the things that happen in the economy based on interest rates. Buying cars, buying houses, taking trips, putting on a credit card, making purchases, everything, right? Everything that we do as consumers, and where our economy is 70% driven by consumption, is all done on credit for the most part. So what happens when interest rates go up, those payments go up, and people wind up having to spend less because their debt service requirements go up? So I only have so much money coming in. I'm not the government, right? I can't print more money as an individual. I have to stop consuming as my payments go up. So economic activity slows down, economic growth slows. And this is why throughout history, there's a very high correlation between interest rates, inflation, and economic growth, because they're all a function of each other. And so when you talk about interest rates going to 5 or 6 or 7% on the 10-year Treasury, think about the impact that has across the entire economy. Now, could you have 5, 6, or 7% interest rates? Yes, you could. As long as you had strong organic economic growth running at 5, 6, or 7%, wages were rising, and inflation would also be running along at 5, 6, or 7%. And that would be completely normal. We've seen that before in history, back in the 80s. So as long as you have good, strong, organic economic growth, not one driven by stimulus, I'm talking about just normal or organic activity, right? So we have to produce first before we can consume. That means that we've all got good paying jobs. We're all making money. We're all living within our means. We're doing all the right things, and we're consuming. And as we get raises at work and we hire more people, that's more people to spend money. They go spend money in the economy. Prices go up. You have inflation because of demand. That creates more profits for companies that hire more people, so forth and so on. So it all works. But that's in a low leveraged economy. That's why it worked back then. Can't work today. Too much leverage. So when interest rates go to 5, 6, 7%, immediately brakes hit. But setting that aside for a moment. 5, 6, or 7%, completely normal in an environment where you have normal buyers and sellers. The problem, we don't have a normal bond market. The Federal Reserve, central banks globally, have massively expanded their balance sheets. They have been a primary buyer of debt over the last 13 years, and that's not going to change in the future. Yes, right now, they're doing quantitative easing to absorb some of the excess that was done from these $5 trillion in stimulus payments, but that will end, and they will have to begin to monetize the debt again in order to keep rates low. Rates can't go up because eventually the Federal Reserve will step in to suppress interest rates as you have an economic hiccup because of higher rates. So every time rates rise to the point that it becomes a threat to economic activity or financial stability, the Fed will push rates lower in order to remove that threat. Financial stability is their number one concern. So the reason that interest rates can't go higher is that eventually the Fed will step in and start buying the debt to push rates lower. And in fact, over the next 30 years, as the CBO has predicted debt to rise, the Federal Reserve will have to monetize roughly 30% of that debt to keep interest rates in line. That means the Fed's balance sheet will be close to $40 trillion by 2053. So no, interest rates can't go up. In fact, right now, bonds are the most oversold on record. And we're getting very close to that point to where the Federal Reserve is going to have to start to step in as the economy continues to slow, and they will when the economy slows further. Doesn't mean a recession, but just slows. When the slowdown in the economy becomes a concern, the Federal Reserve will step in, start lowering rates, and begin to buy bonds. So will central banks around the world. Because again, it's just a function of math that economic activity can't survive in a higher interest rate environment. And again, it's because of the amount of leverage in the economy today that we've never had before. And that leverage has been increasing sharply over the last 13 years because of all this Federal Reserve intervention. And again, we talked about the housing prices yesterday, right? Everybody's complaining about, well, I can't afford a house. I can't afford a house. I get it. Housing prices were super sustainable and affordable through 2019, 2020. It's just been the last 3 years that they've become very unaffordable. And the reason has been because of all this money, right? Everybody went out and bought houses. Right? You give somebody a check and they go, wow, I can afford to go buy, I can afford my down payment now because I can do a 3% mortgage. And they run out and they bought houses. They were buying houses unseen. They were buying houses they didn't even know they wanted. And again, so you have price increases. But that's what happens. And so we've absorbed all of this low interest rate debt. And now as interest rates go up, that higher interest rate is the threat to the economy. And that's why, over the course of the next year to 18 months, and we keep talking about this, bonds are going to be your best investment. They're going to outperform stocks. They're going to outperform everything. In fact, just yesterday, in my personal account, I doubled my bond position yesterday for the same reasons. It's going to take time, right? These are not overnight transitions that occur. But when, this is some basic primary economic math that is going to work out. It's like card tricks, right? Here's a mathematical card trick that you can do at home and it works every time. And I don't know why it works. It's just the math. Take a pair of dice and roll a pair of dice twice. So let's say you roll an 8 and an 11, right? So the 8 is an 8, right? And 11 is a jack. Take a deck of 52 cards, shuffle it up, spread it out, and somewhere in that deck there will be an 8 and a jack together. And you can roll those dice every single time, and it's a function of math, but that trick will work every single time. There will always be those two cards together. Any two cards you roll, those two cards will be together somewhere in that deck of 52. Not necessarily the same suit, but somewhere in that deck, an 8 and a jack, a 6 and a 5, whatever it is, whatever you rolled, those two cards will be together every time. It's just a function of math. This is a function of math. Interest rates have to go lower because of the debt. And that's why bonds, again, continue to be the most undervalued asset in the market, period, hands down. And if you're buying value, there's a value play for you. And it's just a function of math. All right. Wraps up the show for today. Get by the website, realinvestmentadvice.com. Send your questions, comments, emails. Michael's latest article is out right now about stimulus, consumption, and the economy. And in this weekend's newsletter, we'll be doing a technical review of the markets as well. So make sure you subscribe to the newsletter. It's all at the website, realinvestmentadvice.com. Have a great day.